The Nikkei 225 just printed a fresh medium-term bullish forecast, but inside this candle is a trap designed to take your liquidity. There is one danger zone and one hidden opportunity today. I'll show you both. Stay until the end. I'm giving out 3 exact entry and exit levels you can use on Nikkei futures right now. Most traders will buy this breakout. We are going to check if the smart money is actually selling into it. Here is your instant session bias for the Nikkei 225. On the daily and the 5-hour, we are technically trending. But make no mistake, the real structure is range-bound until we clear a critical ceiling. The one invalidation level that proves me wrong is a daily close above 63,430. Write this number down on your hand right now. If we close above 63,430 today, the whole bullish structure shifts into high gear. Until then, every push higher is a potential exhaustion event. Let's narrate the chart from the top down, the way an institution reads it. Start on the weekly. Price is above the 200-week moving average. That is the long-term bull flag. But look at the momentum. The weekly MACD histogram is flat. No conviction. That tells me the big money is not chasing. Now drop to the daily. We have a clear higher-low sequence, but here is the problem. The daily candle is sitting exactly between its 20 and 60 moving averages. The 20 is below, the 60 is above. That is a compression coil. A breakout is coming, but the direction is not confirmed. The daily MACD is showing a bullish cross, but the signal line is still deep in negative territory. That is a weak cross. I call this a technical apology. It says maybe up, but not with force. Now the 5-hour chart, which is your active trading time frame. Price has just pushed above the 200-period moving average on the 5-hour, which is bullish. But immediately above, we hit the first key resistance at 63,350. This level has rejected price 3 times in the last 48 hours. Above that, the heavy line is 63,430. That is the daily resistance. I want you to imagine a brick wall at 63,430. Behind that wall is the path to 64,000. But to get there, buyers must prove they are real. Support is clear. The first floor is 63,140. That is the 5-hour 20-period moving average and the previous breakout level. If that breaks, the next concrete slab is 63,010. That is the decision zone. Lose 63,010, and this entire bullish forecast collapses back into the old range. And here is the cross-asset link that most retail traders ignore. The Nikkei and US dollar to Japanese yen must confirm each other. Right now, US dollar to Japanese yen is hovering near intervention territory. If the BOJ steps in to strengthen the yen, US dollar to Japanese yen will drop hard, and the Nikkei will follow because a strong yen kills exporter. Profits. So while you watch the Nikkei, you must also watch the 158 level on US dollar to Japanese yen. That is the ghost at the party. Yesterday's core news is the Nikkei 225 forecast calling the start of a new medium-term bullish trend amid rising JGB yields. On the surface, that sounds bullish. But let me decode this for you. Rising Japanese government bond yields mean the market is pricing in an end to negative interest rates. That is good for banks but bad for the carry trade. For the last decade, a weak yen fueled the Nikkei. Rising yields threaten that dynamic. The current narrative is a battle between two forces. Force 1 is the global risk-on sentiment spilling over from the S&P 500. Force 2 is the domestic Japanese yield shock. The Nikkei is being pulled in 2 directions. The 1 to 2 week directional lean is this. We will see a fake breakout above 63,350, a retest of 62,800. And then a slower grind higher only if US dollar to Japanese yen stays above 152. What invalidates this thesis? A daily close above 63,430 on volume. That would mean the yields are being ignored and the global risk bid is dominant. But until that happens, I treat every high as a short-term short opportunity for a scalp back to the support zone. The policy differential between the BOJ and the Fed is the key. If US data stays strong, The dollar stays bid, the yen stays weak, and the Nikkei can rally. If US data weakens, the dollar drops, the yen spikes, and the Nikkei collapses. You are trading the spread, not just the index. Most people will skip this next part, but this is where money is made. Keep watching. I am giving you 3 exact strategies. Each one has a specific trigger, stop, and target. Strategy 1, the sniper. This is for the conservative trader who wants high probability. The trigger is a clean rejection from 63,350 on the 5-hour chart. You are waiting for a candle close below 63,200 after testing that resistance. The stop loss goes 4 points above the rejection high, exactly at 63,400. That is a 25-point risk. Target 1 is 63,140, which is a 1-to-1 risk-reward. Target 2 is 63,010, which is a 1-to-1.6 reward. What voids this setup is a daily close above 63,430. If that happens, you do not short. You wait. Strategy 2, the active trader. This is a mean reversion play. The entry condition is a break below 63,140, then a pullback to retest that level as new resistance. You enter the short on the first 5-hour candle that closes below the retest. Stop loss is 20 points above the entry. Maximum 63,200. Target 1 is 63,010. Target 2 is 62,850, which is a 1-to-2 risk reward. Once target 1 is hit, you trail your stop to break even. Type your Nikkei range for tomorrow in the comments now. I am reading them. Strategy 3, the aggressor. High risk, counter trend, only for those who know how to lose small. We are buying the first touch of 63,010 on a wick. Not a close, a wick. You enter a limit order at 63,010. The stop loss is a hard 10 points below at 62,990. That is very tight. Target 1 is 63,140 for a 1-to-1. Target 2 is 63,350 for a 1-to-3.4 reward. The explicit warning is this: if the candle closes below 62,990, you do not add, you do not hope. You are out. This is a liquidity grab trade. You are trying to catch the bounce before the real sellers arrive. Only trade this if you have a small account or you are bored and want to fight. Let's recap those levels. Resistance at 63350 and 63430. Support at 63140 and 63010. The sniper shorts the rejection at 63350. The active trader shorts the retest of 63140. The aggressor buys the wick at 63010. Never risk more than 1-to 2% per trade. No positions through the BOJ intervention use. Stops are non-negotiable. If you lose twice in a row on the Nikkei, close the screen. The one most critical level for the next session is 63,430. That is the line in the sand. Above it, the bulls get the runway. Below it, every rally is for sale. Tomorrow, we focus on the US PPI data and how it changes the US dollar to Japanese yen dynamic. That will be the real driver. If you want the full breakdown on the divergence between Bitcoin and the S&P 500, that video is live now. Check the end screen. Smash like if this analysis gave you a clear plan. Subscribe and hit the bell for daily coverage of all 8 assets. I will see you in the next one.